Hello everyone, good evening. Welcome to the new class. Welcome to VGLD. Welcome to the CMA part 2. So yes, I hope that everyone is doing well. Everyone is all prepared and set to clear their part 2. Is it? Yes or no?
Yes.
Okay, everyone ready, right? Just give a thumbs up. Now see, before we start, I just need one and only one thing from you all is that complete attention, complete doubt asking. Like I want everyone to be attentive in the class and ask as many as doubt you want. Okay. There is no limitation, nothing like that. So just clear one thing that you need to clear your CMA part 2 in the very first attempt, which is most probably in September, October. Okay. So our pattern, as you all know, will read out, will explain, and then we'll solve MCQs of those topic. That's all will go. Similarly, once we complete any section, we'll take a mock also. Okay. So 6 mocks plus one final mock. So is it clear for everyone? And yes, I also want one more thing is that everyone must present regularly. Okay. No one be like not attending any classes. Attend regularly. Okay. So yeah, just give a thumbs up so that we can continue. And yeah, sorry for the inconvenience that yesterday I was not available. Okay. So yeah, give a thumbs up quick so that we can continue. And Naveen, as we had a word yesterday that you will make any WhatsApp group. Have you made any WhatsApp group, Naveen?
No, I haven't made it, but I'll make it.
Okay, you had not made, right?
Yes.
And yeah, I have already made one Google Drive link, which I have sent to the VGLT team. They will provide you. Okay, they will provide you the link in the LMS only, and you will get the Glam book and the your support package there only. And also those who haven't received their particular what we say Becker LMS, get that as soon as possible. Okay. Okay. So yeah, let us start with our first topic, with our first section A, financial statement analysis. An important one with a weightage of 20%, which is a much more expected. Okay. Questions are there. So it is basically divided into 3 units of our Glam book. Unit number 1, unit number 2, and unit number 3. See, we will be using Glam book. Now it's your call whether you use Glam or Becker. Similar only. Glam is a little bit smaller compared to the Becker. So I prefer more to use Glam. Okay. So yeah, before we start further, before we go for anything, let us understand one small income statement and then we will start our other things. Okay. So basically we know that there are certain amounts of financial statements. We all know, right? What are financial statements? So your financial statements are those which provide financial information, which provide the information regarding your company to the external parties, to the one who use their things to get input of your company. So that is financial statements. Basically your company's overall results. So that includes your balance sheet. Okay. Then your income statement. Also you can consider cash flow statement. There are many more other, but yeah, we must know these three right now. Balance sheet, income statement, and cash flow statement. Balance sheet will tell you about the current position of your company, where you are, how much assets do you have, and how much liability do you have, how much equity do you have. That's what your balance sheet says. Income statement will show you the performance that you did the whole past year. Okay, how much profit you made, what was your statement starting to the ending, how you manage, what were their revenues, what were their your expenses and all. Cash flow statement means beginning plus ending and also the remaining, how you manage your cash the whole financial year. Okay, how much cash you received, how much you paid, different methods are there in that. So cash flow is basically divided into 3 units: investing activity, operating activity, and financing activity. So that is cash flow. We don't need to go in so deep because it is not at all needed. So that is what cash financial statement. Because see, being a user, being an investor, being a shareholder, I must know what the company is going on. Okay. Because see, for example, if a parent is there, right? A parent wants to know their child's condition. So similarly, as we get the result at the end of the year, similarly, the company also provide a result, a financial statement to the parent, to the one holding, to the one who are users, like that. Okay. Because we want to know what the company did the whole year, what is their company's current status. So that's what your financial statement, that is why we need to analyze our financial statements. Okay. So who are the users of this financial statements? So there are internal users and external users. So basically, who will be your internal user? So internal users includes many, right? For example, internal users are your employees, your management team. Okay. Similarly, there are certain external users who are not present in your organization but use this. Okay, like your shareholders. It's an external party. Potential investors, because they want to know whether they should invest in a company or not, whether the company liable, whether the company profitable, whether the company will provide a benefit or give a loss. So that is all we needed, right? Creditors, whether they should provide you the credit or not. Okay, your financial institutions, will you be able to get the loan or not? Okay, tax officers, tax officials, they want to know whether your financial statements are as per the standards or not. Okay, government officials, whether you are compliant with the rules and regulations and everything. So these are the users who analyze your financial statement and get the best result from it and make a decision from these financial statements. Okay, so in this part 2 section A, we are here to analyze our financial statements using different methods. Okay, so the very first method is common size financial statements. Basically, this is very simple. I will provide you some notes for this. Okay, where you will be easy for this. Common size financial statement is a method to analyze with the past years of your result or with the competitors. Okay, liquidity measure, whether you have sufficient liquidity or not, whether you have a liquidity or not. Solvency, whether you are solvent or not. Leverage, do the company has a risk or not. Okay, your profitability ratios, whether a company is profitable or not. Okay, then per share ratios, or you can say market ratios. So market ratios includes the dividend payable ratios, book per value ratio, face value per ratio, book to fair value ratio. So many more ratios are there, right? Earnings per share, how much company is providing as a dividend, how much it is retaining for themselves for sustainable growth, and many more. Activity ratios. Activity ratios include like how you are using your assets to generate the revenue, whether you are doing the probable use or not, or are they keeping idle. You will also learn about the earnings quality. How should be the earnings quality? Now, let me take an example with Navin. So, Navin, do tell me, for example, if I tell you that you have a business and in that business, year one was you had a 5 lakh of profit. In the year two, you had 15 lakh of profit, or let's say 15 million you did. Okay. In the year three, you had a loss of, let's say, 1 lakh 50,000. So is it a good sign or a bad sign, Naveen?
It's a bad sign
Why? What's the reason behind this?
because year one profit is 5 lakhs, year two it's 15 lakhs, but in year three it is like very gradual decrease. It is
So
almost like 16
can
lakh
we say
50,000
that
has
it is
come.
not stable,
Yes, it's unstable now.
unstable, and there is a huge volatility, right? So
Yes,
your earnings quality is not good, right?
correct.
So yeah, we are just analyzing all such things in part two. So is it clear for everyone what we are going to study? Just say yes or no.
Yes.
Okay, let's go. So let's start with our first topic and see. Chill. No need for any like worry about it. Nothing. Just be chill. Okay. See, Navin has made a group. So everyone must have this link and will join at the end of the class. Okay. So be chill, be fun. We'll do fun and everything. Okay. So no need to be so much stressful. Take a chill pill. So let's start with the first topic, that is known as financial statement analysis. Common size. See, there are two methods. One is a vertical method and one is a horizontal method to analyze your financial statements. So we'll compare our financial statements. We'll compare with the percentages of our financial statements, having two methods, vertical and horizontal method analysis. Okay. So analyzing the financial statements of steadily growing firms and the firms of different sizes within an industry presents certain difficulty. Yeah, we know that, right? If we are having a steady growing firms and on the firms of different sizes, it's very difficult to have comparison between them. Okay. So to overcome this obstacle, financial statement restates financial statement line items in a line of percentage of a given amount, such as total assets for a balance sheet and net sales for an income statement. See, you are going to compare your balance sheet with the total assets. Okay, and you are going to compare your income statement with the net sales. You are taking out a percentage, taking the basis total assets in balance sheet and net sales in an income statement. So items on common size financial statements are expressed as a percentage of sales on the income statement and total assets on the terms of balance sheet. So the base amount is assigned as value of 100%. That means on income statement, your sales is 100%. On balance sheet, your total assets are 100%. And other things are taken on that basis. Okay. So let's see here. See, it's an income statement given here. Okay. So in this income statement, they are taking out the percentage by keeping net sales as 100%. They're comparing current and prior year by taking sales as 100%, because you cannot compare directly, right? Because there might be possibility that their sales is different and due to which their cost is different, right? So there will be a disbalance. If you want to compare, we need to compare with the equal base. And if equal base is not available, we can't compare. Okay. So for example, if I want to take the percentage for operating income for let's say current year. So that would be operating income is 85,000 divided by net sales of that year only 1.8 million. That would be a different term, right? So that is 85,000 divided by 1.8 million into 100 is 4.72%. Similarly, if we go for the prior year, that is 45,000 divided by 1.4 million. So that makes a difference. So 45,000 divided by 1.4 million, that gives 3.21 percentage. See, so I can say that my operating income has gradually reduced from prior year to the current year. That's how we make a difference. Similarly, we can make a difference in our balance sheet also. How do we make? By taking total assets as a base. See, total assets is 100%. So for example, if you tell me that we need to take out the percentage of non-current liabilities. Okay. Non-current liabilities. So in this thing, let's say for current, we'll take first. Non-current liability is 6,10,000 divided by total assets 1.8 million. So that is 6,10,000 divided by 1.8 million into 100 is 33.9%. Okay, for if we take out for prior year, that would be to current non-current liability 675,000 divided by 1.6 million into 100 is 42.2%. So ultimately there is a decrease in your non-current liability and that's a good sign, right? So we can make comparison like this way. So I hope that everyone is clear with this thing. So for income statement, we'll take net sales as a base and for balance sheet, we'll take total assets as a base. Okay. So common size statements simplify analysis of difference among companies of various sizes or comparison between a similar company and an industry average. So for example, comparing the efficiency of a company with 1.8 million of revenues with a company with 44 billion in revenues is difficult unless the numbers are not reduced in a common denominator. See, for example, if I want to make a denominator, right? If I want to compare, So am I able to compare a 5-year child with a 15-year child? Is it a good comparison? No. But unless and until they are in a same base, they can comparable. Right? If, for example, if I say they both are in the same standard, they can compare. So what we did here, a revenue of 1.8 million and a revenue of 44 billion. What I did, I just made it as a denominator and got a comparison. I got a simple variable comparable value. So let's start with the two analysis, vertical and a horizontal analysis. So by the name itself, it's vertical, right? So that means like this. So remember like this, vertical is this. So the vertical is the base. The vertical common size financial statements provided are an example of vertical analysis. So whatever we studied till now, like in balance sheet, we'll take the percentage of what we take the balance sheet percentage. If I want to compare the balance sheet, what do I take as a base? Who will tell me? Let's remember. Let's read it out again. If I want to compare the balance sheet, what I need to take it as a base? Yes, total assets. But for a income statement, what I need to take? Total sales. Yes, correct. Good. So yeah, Maruti, Prasanna and Jeep. Good. Navin also. Yeah. Try it out. Okay. If it is wrong, no issue. So that was for a vertical analysis. Now see, vertical analysis has so many other name also. You can say it as a common size financial statement analysis, trend analysis. You can't say trend, but it is basically other name is common size statement analysis. Okay. Common size financial statement analysis is known as vertical analysis. So your vertical analysis, what we do for balance sheet, we take a base as our total assets to compare. Okay. For our income statement, we take net sales as our base. And when it is comparable, to compare the firms of different sizes, to compare the firms of different size or with the competitors. That is what it is now, to compare with the competitors, right? So to compare the firms of different sizes or with the competitors, we use vertical analysis. That's it. That's how simple it is. Okay. Similarly, horizontal analysis. So horizontal analysis means like this. Remember like this. Horizontal analysis. So horizontal analysis is also known as trend analysis. What do we call it as? Trend analysis. Also known as trend analysis. So another concept is horizontal analysis. It states the amount for several periods as a percentage of a base year. Now here we'll take the denominator as a base year item. So see, if in the question it is given the base year, the last year, then it's okay. But if it's not given, then take the very first year as your base year. Okay. Here we are going to compare the same company with previous periods. Same company is being compared with the past periods. Okay. So that is your horizontal analysis. That is very easy, very simple only. So see, as we can see in this question. So another concept is horizontal analysis. It states the amounts for several periods as a percentage of base year amount. These are often called as trend percentages. As I told, it is also known as trend analysis. So one period is designated the base period with which the other periods are compared. For example, if I take that 2000 was a base year and I will compare 2020, 2001, 2002, 2003 with that 2000 year only because that was my best year. Okay. So each line item of the base year is thus the 100%. So for example, in this, the second prior year is the base year and all the items of the second prior year are the 100%. For example, if I want to take out the percentage for net sales for the current year. So how I will work for it? 1.8 million divided by 1.5 million into 100. I get 1.8 divided by 1.5. That's 120%. So can I say that it has increased by 20% compared to the base year? Because 100% was the base year. Now 120 means it has increased by 20%. If I take for the prior year, it was 1.4 million divided by 1.5 million into 100 is 93.33%. So we can say that it has been decreased by 7% or 6%. Okay. So that's how it works. Similarly, for cost of goods sold, 1.65 million divided by 1.39 million. Okay. 1.33 million divided by 1.39 million. So that's how it works. Okay. That's how simple it is. Clear? So that was for same. If it is for balance sheet, base year item. If it is for income statement, same item, nothing else. Okay. So that is your horizontal analysis. Okay. So trend analysis compares financial information for the balances and amounts across statement periods. It allows the financial analysis to identify patterns in data from year to year. Like from year to year. Year one it was increased, year two it got decreased, like that. And make comparison with the competitors and industry benchmarks. Either we can compare with my competitors or with the benchmarks. That's it. So this type of trend analysis also is used for business decisions. It is also being used for business decisions. Okay. So this is also the form of horizontal analysis that doesn't use common sizes. This method is known as growth or decline of a key financial statement. So there is one more, growth rate analysis, which is not given in so deep, but we'll take it. So can you help me remember in a horizontal analysis, what we take as a base here? What we take in the base? In a horizontal analysis, what we take it as a base? Which thing we take it as a base? We take a base here, right, Jeet? Correct. So in a growth rate analysis, the past year, just the previous year, will take it a base. For example, see, here, the current year and the prior year. So we'll take the current and the prior year only. Only the just prior year will take for the example. For example, the selling expense. So the formula is prior year, sorry, current year less prior year divided by current year into 100. Sorry, divided by the prior year, previous year. See here, selling expense was 15,000, sorry, 50,000 this year. Last year it was 15,000 divided by 15,000. So you get as 50 less 15,000. It has increased by 35,000 divided by 15,000 into 100. That gives you 233.33% increased. So your selling expenses has increased from the prior year by 233.33 percentage. So growth rate analysis is the third one. One was vertical, where we take per income statement, net sales, balance sheet, total assets. In horizontal, we took base year as 100%. In a growth rate analysis, just a prior year, we take as 100%. Okay. So that was your common size financial statement analysis. So this is another form of management by exception. Managers can look at the percentage change column and see what accounts have experienced the most change since the previous year. So we can make changes like what is the most thing which we need to carry on. For example, see the selling expense has increased by so far, like it has increased by 233%, which is a very huge. So we need to focus on that. That is why there is a term. This is another form of management by exception. That means management will look onto those factors only which needs a more timeage. Because see, management don't have so many time. Okay. They are not free always. So they must go to those topics, those areas where they needed the most. So as I can see that selling expense needed the management time the most. So that is why management by exception plays here. So management can look at the percentage change column and see which accounts has experienced the most change. So that is your selling expenses. Okay. So that is your management by exception. So management by exception means to focus on those areas which needed the most amount of time periods. Okay. So is it clear for everyone? Yes or no? Just give a thumbs up quick. Everyone, give a thumbs up, quick. Just thumbs up, guys. There's a option in your page. Go for a thumbs up. It's very simple. I want to know that whether you got it or not. Okay, I hope that everyone got it. Now, as per me, we should go for some questions so that you get more and more clarity from this. Okay. Look at the question. See, a very huge question, right? With nothing much as like what we say, with nothing much any information given. So see, what they are shown. Whenever such questions are there, na, see from this question, I can be clear that your options are more important here compared to the things. Your options are more important. Okay. So what they are saying, Gordon has analyzed these results using. Gordon has found the as at the financial results for the last year. 1, 2, 3, 4 years are there. So that sales cost of goods sold gives gross profit. Sales less cost of goods sold gives gross profit. That's it. Also, he has given some inflation factor. Gordon has analyzed this result using the vertical common size analysis. Vertical common size means taking sales as a base. Okay, in income statement. The performance of Gordon can best be recognized by which of the following statement? So, see, these statements are given, four statements are given A, B, C, D. Compare this, read this, and try to answer it. The common size gross profit percentage has decreased as the result of increasing common size trend in a cost of goods sold. It says that your cost of goods sold has increased. So, see, cost of goods sold has decreased as per me, right? So, this is not an answer, right? Clear? Is it or not? Because cost of goods sold has decreased now. Can we say that the cost of goods sold has decreased? So this is not an answer. No. See why we can't say this? Because we need to find the percentage first. Okay. For all these years, we need to find the percentage using this vertical analysis. So let's take sales, COGS, gross profit. Year one, year two, year three, and year four. Okay, what's the sales percentage for year one? 100%, right? Then COGS. Now see what's the percentage of COGS? 7,50,000 divided by 1.25 million into 100. That is 60%. Similarly, who will help me to find the year two's cost of goods sold percentage? Vishwajit, you help me out. Tell me the answer. Who will tell me? Just raise their hand.
So, 7,85,000,
Yes.
yeah, divided by, uh, sorry, 1 crore 25 lakhs.
Why 1.35 lakhs? Year two we are looking on na 785
Yes,
divided
yes,
by
sorry,
1.3
sorry.
million.
Yes. Yeah, 1 crore
That
30
is
lakhs.
Yeah, that is 60.38. Next. Who will help me for the next? Raise their hand. Raise your hand, guys. Raise your hand. Try to answer it. Otherwise, it won't be possible for you all. Be attentive. Anyone wants to answer? Yes, Ji. Tell me. Yes, Ji.
60.70.
Yes, correct. 60.70. Next, for the year 4, it is. Go for it, Jeet. 60.71, I guess.
60.71.
Yeah.
Yes, sir.
Next, for gross profit now. 5 lakh by 1.25 million. That is 40%.
20%. 39.62.
39.62.
Yes.
Then
39.29.
39.29. Yes. Then
39.29.
again
Approximately.
same. Okay, 39.29. 285 we can take, no? Or let's say 29. Yeah, see what they are saying, the common size gross profit percentage has decreased. Is it decreased? So yeah, it has decreased, right? It has decreased. Then as a result of increasing trends in cost of goods sold, is your cost of goods sold increased or decreased? Yes, the trend in the cost of goods sold has increased. So similarly, just without looking at the answer, other options, option A is correct. Got it, everyone? So yeah, that's great. Okay, that's clear. The common size trend in sales is increasing. Yeah, sales is increasing and is resulting in increasing trend in the gross margin percentage. No, gross margin has declined, so not this answer. Then common size trend in cost of goods sold is decreasing. Cost of goods sold is not decreasing, it is increasing. So ultimately not at all this answer. Then the increased trend in the gross profit percentage. There is no increase in the gross profit. There is a decrease in the gross profit. So option A is correct. Very easy, very simple. Just peel out the question. Okay. Hey, from you, who had a chat with me on WhatsApp today? I forgot the name. Who was the one who I had the chat today in the evening? Next question. Shown below are the components of a company's financial statement. What percentage would the net income be on the common size financial statement? What should I take this net income as a percentage? Arzu, you tell me the answer now. What to be done here? Who will tell me the answer? Jeet got the answer also. That's great. So percentage to find the net income is 120 divided by net sales is there. Oh, sorry. Income statement is there. In income statement, we take the base as sales revenue divided by 6 lakh into 100. So that simply gives me 1 lakh 20 divided by 6 lakh into 100. That is 20%, option number C. Very easy. Jeet got the answer. Good, Navin. Next, a big question again. What to be done here? A financial analyst is reviewing a competitor's income statement. He is reviewing a competitor's income statement for the past 2 years. The financial analyst is able to conclude that the competitors dash. And when we use competitors, right, what we say, what we find, we take it as a base year. But see here, it is not specified whether they are using the horizontal analysis or vertical analysis. So we'll see the options. Common size income statement will show operating income before taxes at 22% for the year 2. Common size income statement. That means for the year 2, check out the year 2. Okay, 25,000 divided by 275 into 100. How much percentage it is? 25 divided by 275 into 100. So that is 9.09. So ultimately not at all this answer. So option A is not correct. Okay. Then common size income statement will show taxes related to the operations at 16% for year 2. Let's see. Is it 16%? 16% or not? 3500 divided by 275 into 100. So that gives me 1.27. So ultimately not at all this answer. B is also not correct. Now let's see for other third and fourth. The common base year income statement will show a gross profit increase by 17%. Common base year income. So year 1 will be your base year. Year 2 will be your current year. So gross profit has increased by how much? They are saying that 17%. Let's see. 115,000 less 95,000 divided by 95,000. Check it out. 115,000 less 95,000 divided by 95,000 into 100. So that is 21%. Not for 17%. So option C is also not correct. Next, let's go for the fourth option. So ultimately fourth will be your answer, but still we need to conclude this. Base year income will show selling expenses increased by 14%. Let's see the selling expenses. 40,000 less 35,000 divided by 35,000. 40,000 less 35,000 divided by 35,000. Yeah, that's 14.29%. So yeah, it has increased. Somewhere similar only. So option D is correct here. Okay. So see, very simple, right? By just looking at the answer, I was able to give it the point. Yes, Navin, correct, good. Navin was knowing the answer, great. So yes, this is how you can solve such questions. Very simple way. Using horizontal analysis, what amount has the largest percentage change? Let's see what amount has the largest percentage change. We are using a horizontal analysis. Horizontal means we take what is a base year, we take every base year as a line item. So that is 6.6 million divided by 6 million into 100. So 110%. It has increased by 110%. Then your net income 540 divided by 5 lakh into 100. So it has increased by 108%. Then comes your total assets 1.5 million divided by 10 million. So that is 105% increase. And inventory 5 lakh divided by 6 lakh. It has reduced, right? So that is 83.33%. Now check the change. So here you can see that sales has increased by, sales has increased by 10%. Okay. Net income has increased by 8%. Total asset increased by 5%. And your inventory has decreased by 16%. So which has the highest change? What do we conclude? Which has the highest change? That's inventory. Inventory got the largest change. Okay, so that's D is your answer. I hope that's clear, everyone. So that doesn't matter whether it is increasing or decreasing. Only thing matters is whether it is going in a right direction or not. Okay. So that was your first topic that we completed. Okay. So yes, just give a thumbs up that everyone got the very first topic, common size financial statement. There are three methods. One is your vertical analysis, where you need to compare it with your competitors with the firms of different sizes. In that income statement, we take the base as our net sales. In balance sheet, we take the base as total assets. Okay. Then comes your horizontal analysis, which is also known as trend analysis. That is useful to compare your past results. Okay. To compare your current with the past results with the base year. So we take base year as 100% there. Then comes your third, growth analysis. We compare it with just previous year. Okay. So that was your common size financial statement analysis. Now, the next second topic is your liquidity. Liquidity. That means water, right? Is it? What is liquidity? Anyone? Anyone knows what is liquidity actually? So we say liquid. Liquidity means is a measure, right? Liquidity is a firm's ability to pay its current obligation. Current obligation means the amount which is due within 1 year, within one operating cycle, as they come due, and thus remain in the business in the short run. So liquidity reflects with the ease with which assets can be converted to the cash. So here we are going to take only those assets which are similar to your, which are equitable to the cash. Those are your current assets. So let me give a definition for the current assets. Current assets are those assets which can be converted into cash within 1 year or within one operating cycle, whichever is larger. So the assets which can be converted into cash within 1 year or within one operating cycle are said to be your current assets. Okay. So your operating cycle depends on your business. If the business is, let's say, of construction, the operating cycle can be of 2-3 years, because procuring raw material, producing, then selling, then receiving the cash, that's all time period includes in your one operating cycle. Okay. So that's the measure of your liquidity. So here we are going to compare your current assets with the current liability. Current liability is those which you need to pay within 1 year, within one operating cycle. That's it, as they come due. So liquidity is for the short term, not for the long term. Liquidity is for the short term. Solvency is for the long term. Okay. When you have a measure to look for the short term, you have liquidity. So here we are going to learn about the working capital, current ratio, quick ratio, okay, cash ratio, and many more different ratios we are going to learn and study about this. So everyone must remember the formulas for these ratios, as it is very much important. So that's your balance sheet. That's how we are just going to look at this current assets and this current liability session. That's it for our liquidity topics. Okay. So your current assets includes cash and cash equivalents, available for sale securities, account receivables, notes receivables, inventories, prepaid expenses. While current liability includes accounts payable, notes payable, accrued interest on notes, current maturities of long-term debts. Like for example, if I have taken a loan for 20 years, so the EMI that I need to pay in this year is my current maturity of long-term debt. Okay. Accrued salaries and wages, which I need to pay. Income tax payable, the amount that I need to pay to the income tax purpose. So these are included in your assets, current assets and current liability. Similarly, there is an income statement given. So income statement includes net sales less cost of goods sold gets gross profit. Gross profit less selling general administrative expense gives you operating income. Operating income plus or minus other expenses, revenues and losses, you get EBIT. EBIT less interest gives EBT. So see here, let us write one income statement. Everyone must note it down. Sales less COGS. COGS is cost of goods sold. You get gross profit. From this gross profit, when you deduct selling, general and administrative expenses, what you get? You get operating income. Now this operating income, if there is no other revenues and losses, you compare this operating income as EBIT also. EBIT is earning before interest and taxes. And when you deduct your interest expense from this, there remains only one thing, EBT, that is earning before taxes. Earning before taxes. And when you deduct your tax from this, what you get? You get net income to you. Okay, the final answer. Okay. So that's very simple and easy. Yeah, EBITDA is also there. That's not AMD, that's ADM. That's ADM. Maruti, that's ADM. That's administrative. Yeah, we are not going to look about this administrative depreciation amortization for now, because we are looking for the financial statement, income statement, no? Not for now. Okay. Maruti, clear? For now, we don't need to consider that. We'll consider it as in an upcoming sessions. So just remember for now this, okay? Because you will forget whatever we have studied. You will not be able to gain. EBIT is Priyadarshini. EBIT is earning before interest and taxes. Earning before interest and taxes. So before we deduct interest and taxes from our revenues, from our earnings, the sum is known as EBIT. Okay. And when you deduct the interest from it, it is EBT. That is known as earning before taxes. Clear, Priyadarshini? So that's very simple. So yeah. So current assets are the most liquid assets. Okay, current assets are the most liquid one. Maruti, what is PAT? Can you say the full form for this PAT? Profit after tax. Yeah, we can take that. That same. Profit after tax. Correct. Net income and profit after tax are correct only. Same only. Oh, okay. Current assets are the most liquid assets. Okay. They are expected to be converted to cash, sold, or consumed within 1 year within one operating cycle, whichever is longer, as I told. So ratios involving current assets thus measures the ability to continue operating in the short run. Basically, the ratios which are going to learn now, it will help you to say whether you are good enough to cover your concepts, whether you are good enough to cover your cash, to pay your cash in the short run. So current assets includes in the descending order of liquidity, cash and cash equivalent, marketable securities, receivables, net allowance for the credit losses, inventories and prepaid items. Okay. Current liabilities by the same tokens are the ones that must be settled the soonest. Okay. Especially they are the expectable to be settled or converted to other liabilities within 1 year or operating cycle, whichever is longer. So current liabilities includes your accounts payable, notes payable, current maturities of long-term debt, unearned revenues, taxes payable, wages payable, and other accruals, as I just gave an example. So now net working capital. Net working capital reports the resources the company would have to continue operating in the short run if it had to liquidate all its current liabilities at once. So net working capital's formula is current assets less current liability. Current asset less current liability. See, right now I'm in a business, okay? I have a huge business of, let's say, t-shirt manufacturing. So I have some inventories, right, in it. And let's say I produce more inventory. The inventory is added. So that means I have added working capital. For example, if I sold on credit. So when I sell on credit, I generate accounts pay, account receivable. So that is my increasing working capital. So if we take the working capital here, working capital is equals to, for the current year, 760,000 less 390,000. That is 370,000. Very simple. Similarly, for prior year, that's 635,000 less 275,000. That is 360,000. That's working capital, right? So whatever we have excess, for example, if I purchase on credit, I have increased my working capital because I have increased my current liability. So think like that. So if you think like that, your mind will develop, your thinking will be process increasing. Okay, thinking process will increase ultimately, definitely. So that was your working capital. Now, current ratio. Yeah, Maruti. See, working capital is, for example, I purchase inventory. So when I purchase inventory on credit, I generated my accounts payable, right? Accounts payable I generated, that means my current liability increase. So if my current liability increases, my working capital reduces, right? Yeah. For example, right now I have current asset I have for 5 lakh. Okay. And current liability I'm having for, let's say 2 lakh. Now, let's say I purchased inventory from Naveen on credit. Purchased inventory on credit For how many? Let's say I purchase for 150. So can I say that my current asset has increased? Who will tell me how my current assets have increased by 150? What's the reason why I'm increasing my current assets? Is there any reason why I'm increasing my current assets? I purchase inventory. Current assets includes inventory. Then current liability is also increasing. 2 lakh plus 150. Why current liability is increasing? Because I purchase on credit. My accounts payable is increasing. So that means like this. So right now my working capital was, let's say my working capital was 5 lakh less 2 lakh was 3 lakh. And how much now after this purchase? I guess no change. Because when both side increases, there will be net change 0. 650 less 350. 3 lakh only. Very simple. Okay. So we need to think like that. Okay. We need to clear our thinking like this. So yeah, that's it. That was your working capital thing. Very simple, very easy also. Next, current ratio. Current ratio is also very simple. Current ratio includes current assets divided by current liability. Now see, I will give you a very small tip for this because I have like got a thing for this to solve the MCQs a very quick way, not to think so many things. So we'll tell you that also, but with that we'll do one more ratio for this. Okay. So current ratio is current assets divided by current liability. So it is a measure to show that company's ability, whether they will pay, whether they are capable enough to pay their short-term loans and all with the short-term funds. So current ratio is equals to current assets 760,000 divided by 390,000. That is 1.94. That's ideal, right? If the ratio is greater than 1, then it's good that the company is well enough. Company has more number of current assets compared to the current liabilities. Let's see for prior year. What was for the prior year? 635 divided by 275. 2.31. So yeah, I can say that my current ratio has gradually reduced. Okay, it has reduced. That means, but still, I am capable enough. My ability is good enough. I am a liquid person. I have a sufficient liquidity to pay for my short-term loans. That's it. So that's the formula for your current ratio. Current asset divided by current liability. If it is greater than 1, then it's good. If it is 2:1, then it is definitely good. A good amount of standard ratio. So a low ratio indicates a possible solvency problem. A firm with a low current ratio may become insolvent. Therefore, care should be taken when determining whether to extend credit to a firm with a low ratio or not. Similarly, see if I don't have a current ratio of a good, okay, my current ratio is very low. That means I don't have a possible solvency. I have a certain solvency problem. I might not be able to pay my short-term loans, right? And also, see, that might create problem. I might not get a credit. No one is able to get credit to me, nor even I would be able to give credit to anyone. But still, if it is higher, then manager may not be investing idle assets productively. That is also an issue. If it is higher, that means I have my idle assets in my company. I am not taking those all things productively. I am having an issue. So if it is low, then it is also a problem that I am not solvent. If it is higher, that means I am not using my assets productively. The quality of account receivables and merchandise inventory should be considered before evaluating the current ratio. We need to consider the quality of our account receivables and merchandise. Whether they are overvalued or not, whether they are obsolete or not. We need to consider that. Because this might can inflate. For example, if I am a vegetable seller, I have a 50 kgs of tomato in my factory. 50 kgs of tomato, right? But 30 kgs are obsolete. still I am considering those in my current ratio, which is a wrong. Okay, which is a huge wrong. It's an overvalue. I need to write off those assets. I need to deduct my inventory value by 30 kg. I need to make it 20 kg. Okay, otherwise it will inflate my current ratio. My current ratio will not show the actual impact. Okay, so the general principle is that the current ratio should be proportional to the operating cycle. Thus, a shorter cycle may justify a lower ratio. The shorter cycle justify a lower ratio. That's it. A grocery store has a short operating cycle and can survive with a low current ratio. Then could a gold mining company which has a much longer operating cycle. For example, see, a shorter the operating cycle, the shorter the ratio would be. For example, if I am a grocery store, vegetable seller, right? So my operating cycle will be lower because I purchase, I sell, I purchase, I sell. If a gold mine is there, it take times to procure and then time to sell it off and then take times to get the amount back. So that cycle is very long. And if the cycle is very long, my current ratio would be very higher because my assets are kept idle. So that makes a huge difference here. So is it clear for everyone? Current ratio. Similarly, there is a quick ratio. Quick ratio is also known as acid test ratio, where from the current assets, you just subtract your account or your inventory value and the prepaid expenses. So you take it as a quick asset. Quick asset. So that is current asset less, or you just add three things: cash and cash equivalent plus marketable securities plus account receivable. That's it. Only three items: cash and cash equivalents, marketable securities, and account receivable. And denominator will be same. Denominator will be same. Current liabilities. Only remove the prepaid expenses and the inventory. Because see, quick asset says that to liquidate your inventory, it will take time. To liquidate your inventory, it will take time. Because it's not possible that you are just selling tomorrow. Not possible. It might take 2 years, 3 years, 4 years to sell your inventory. Depends on the nature. So quick ratio is equals to quick assets divided by current liability. Quick asset divided by current liability. That's it. Okay. So quick or the acid test ratio excludes inventories and prepaid from the numerator. Inventories and prepaid from the numerator that we did. Okay, we make it as a quick asset. Recognizes that those assets are difficult to liquidate at that stated value. If I, for example, you tell me an example that I have a huge house, okay, and I want to sell it. If I want to sell it early, I need to sell it for the lower price. But if I want a desired value, I need to wait. So quick ratio says we don't need to wait. We just want amount our now itself. So that is why we are removing it from our numerator. So quick ratio is thus a more conservative than basic current ratio. Okay. So the ratio measures the firm's ability to pay its short-term debts and avoids the problem of inventory valuation. That's it. It is avoiding the problem of inventory valuation. We don't need to evaluate. We don't need to liquidate our inventory. Now, quick ratio. First find quick assets for the current. That's 325,000 plus available for sale securities 165 plus account receivable that is 120. Note receivables also come take that 55,000. No inventory, nothing else. So 325,000 plus 165,000 plus 120,000 plus 55,000. That makes 665,000. Current liability same. That is 390. So your quick ratio is equals to quick assets by current liability. That is 665 divided by 390. That gives you a sum of 1.71. So that's nice, right? That's a good amount. It is greater than 1, then it is good. Okay. So that's how it works. That's how your quick ratio and current ratio. Now, before we go further, I want to show you one simple trick. How you can make simple, using the simple techniques, you can evaluate your things. Let's see. For example, if your current assets are 5 lakh, current liabilities are, let's say, 2 lakh. Your quick assets are 350. Okay. Now find out first current ratio. Find out the current ratio. That is 5 lakh divided by 2 lakh. That's 2.5. Quick ratio is 350 divided by 5 lakh. Oh, 350 divided by 2 lakh. 1.75. If your current ratio or the quick ratio are greater than 1, current ratio or quick ratio are greater than 1, then remember one thing. If you are increasing the same amounts in both the numerator and denominator, what will happen? Let's say your quick assets now became 5 lakh plus 2 lakh, 7 lakh. Let's say you had a thing, that is why it has increased. Current liabilities also increased by 2 lakh. Sorry, that's 2 lakh plus 2 lakh, 4 lakh. Quick assets also increased by 2 lakh. Now find out the ratio. Find out the current ratio. 7 lakh divided by 4 lakh. 1.75. Quick ratio. 1.375. Oh, what happened here? It has decreased, right? So when we say that if the ratio is greater than 1, if the ratio is greater than 1, that means increase, increase, decrease. See, increase, increase, the ratio goes down. If the increase in numerator and increase in denominator, your ratio will go down. Similarly, if there is a decrease in numerator and decrease in denominator, the ratio will go up. Okay, the ratio will go up. Let's check it out that also. Let's say your current ratio became 5 lakh less 2 lakh. Let's say, or let's say we reduce it by 150. So there remains a certain amount. Current liability 2 lakh less 150. 50,000. Then quick asset 350 less 150. That gives you 2 lakh. Okay. Now find the current ratio. 350 divided by 50,000. That gives you 7. That's current ratio. Quick ratio would be 2 lakh divided by 50,000. That gives you 4. That means if the ratio is greater than 1, then decrease, decrease, increase. So write it now. If the current ratio or the quick ratio is greater than 1, then increase in the numerator and increase in the denominator, the overall ratio goes down. And if there is a decrease in the numerator and decrease in the denominator, the overall ratio goes up. That's clear, everyone? So got the point what I am trying to explain? So it's a short form. Like if in the question it says that state the decrease, whether the ratio will go down or up. That's how you can do it. Just looking at the ratio amount. If it is greater than 1, then increase, increase, decrease, and decrease, decrease, increase. Similarly, there is another opposite scenario. Let's say the current assets are 3 lakh. Current liability has 4 lakh. Quick ratio has 2 lakh. Now find out the current ratio first. 3 lakh by 4 lakh. That's 0.75. Less than 1. See, the current ratio or the quick ratio is less than 1 now. Now, let's try to increase. Let's increase by 2 lakh. So your current assets become 5 lakh. Your current liability becomes 6 lakh. We are increasing by 2 lakh. And your quick ratio becomes 4 lakh. Now find the ratio. That's basically a mathematics. So that's 0.83. See, it has increased. So if the ratio is less than 1, then increase, increase, decrease, and decrease, decrease, increase. .67. It has increased. So increase, 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 and decrease, decrease, decrease. So that was the one scenario. Now let's decrease it up. Current ratio, current assets decreased. 3 lakh less 1 lakh, that's 2 lakh. Current liability, 4 lakh less 1 lakh, 3 lakh. Quick assets, 1 lakh. Two lakh by 3 lakh. It has decreased. Simple. Okay. So write it down again. If the current ratio or the quick ratio is less than 1, then if there is an increase in the numerator and increase in the denominator, then the overall ratio will go up. If there is a decrease in the numerator and also in the denominator, then the ratio goes down. Is it clear, everyone? That's very simple and informative. Okay. So must remember these things. Must write it down as a note. Now, the next ratio, that's other liquidity ratios. That includes your cash ratio. So your cash ratio is more conservative than your quick ratio. In the numerator, only two things: cash and cash equivalent plus marketable securities. So that's your cash assets divided by current liabilities. So if we look into this formal example, your cash ratio is equals to cash and cash equivalent 325 plus marketable securities, that is 165. No needs for any payable, nothing. Simple, divided by 390. So that makes 325 plus 165, 490,000 divided by 390,000. 1.25 or 26. Very simple. Cash ratio is equals to cash and cash equivalent plus marketable securities divided by current liabilities. Denominator is same, no matter what. So if it is greater than 1, then it's good. Then comes your cash flow ratio. So your cash flow ratio is basically reflects the significance of cash from operating cycles. Whether you just checking like from your actual cash flow operations, because see, there are two types of things, two types of accounting. One is accrual basis of accounting and one is cash basis. What we actually do is accrual basis, because we have certain things in accrual basis. In a cash basis, we only enter when we accept or pay cash. Okay, but in accrual basis, whether we accept the cash or whether we pay, we enter, whether it is account receivable or anything. But in cash basis, only cash is involved, then only we enter. So we need to take significance from that also. So cash flow from operation, no need to find, it will be given to you, divided by current liabilities. So cash flow from operations divided by current liabilities. For example, see, here the cash flow from operation is 382. So cash flow ratio is equals to cash flow from operation. Cash flow from operation, that is 382,000 divided by 390. So that's 382 divided by 390 is 0.98, which is not right, which is not good. It must be greater than 1, but still it is nearer to 1. We'll accept it. but our liabilities are more compared to our actual cash flow. Okay, so that is also one formula, cash flow ratio. See 0.79 or 78. There is one more ratio that is known as net working capital ratio. So net working capital ratio is more conservative. Only consider the working capital divided by total assets. Net working capital ratio is equals to working capital divided by total assets. Okay. Why we take total assets? Because working capital also includes the current assets and current liabilities. So need to consider that. Okay. We need to check how much of our total assets are associated in our working capital. So let's find first working capital here. That's 760,000 less 390,000. That is 370,000. Okay. So your working capital ratio is equals to 370,000 divided by total assets. How much are your total assets? That is 1.8 million. So here we consider that your assets, working capital are the percentage of our total assets. That is 0.2021. Okay. So from your total assets, 0.21 part is your working capital. That's how simple it is. Very easy. So that's how it's simple. So I hope that everyone is getting what the liquidity ratios are. Okay. Now, liquidity of current liabilities. So the liquidity of current liability is the ease with which a firm can issue a new debt or raise a new structure. Because see, when you liquid your new assets, it is very easy because you can issue the new debt or raise a new funds from different securities. So liquidity of current liabilities indicates the ease of funding or availability of sources of funding. A firm's ability to borrow in the financial market is generally a function of its size, reputation, credit worthiness, capital levels. Like see, if you are capable enough to pay, okay, if you are paying enough for your liabilities, for your current liabilities, that shows that your credit worthiness is good. You pay your debts timely. It depends on your size. It depends on your ratio. It depends on your reputations. Okay. And on that basis, you can get new source of funding. It will be easy for you. For example, uh, I am a person who takes loans simultaneously. Okay. I take a loan very frequently and I pay also at a described time. So my credit worthiness is good. My reputation is good. My size of a firm is very huge. So I will get more fund also if I need. And also the other sources of funds are open for me now. So raising liquidity during an adverse situation often requires a combination of both asset liquidity and liability liquidity. For example, if I tell you that I had a huge adverse situation. Okay. And due to this, I need to have certain funds. So what I can do? I can liquid my assets. That means I can sell off my assets, which are liquid, which are current assets. And also I can liquidate my liability. I can get the fund from the liability. Okay. That is what the liquid liability is. Okay. Clear? So it's very important to pay your funds, short-term funds timely and clear with it. Okay. So that is an easy term. That is what your liquidity function is. That is how it works. So I hope that everyone is clear with the formulas. If yes, just give a thumbs up quick. Then we'll start the MCQ session. Okay, that's great. So I hope that everyone is clear with the topic. with the important things. Now let's go for the MCQs. It's a time for us to go for the MCQs. Okay. In analyzing a short-term liquidity of a company, many analysts prefer to use quick ratio or the asset ratio than the current ratio. Okay. They prefer quick ratio than the current ratio. The primary reason for this preference is, now see, why do I prefer that thing compared to another? There might be the difference between them, no? So what's the difference between the current ratio and the quick ratio? I know that somewhere. That quick ratio and the current ratio is only one difference. Is that inventory things, right? So let's read it out. Quick ratio excludes current account receivable. No, quick ratio includes account receivable. So that is not an answer. Current ratio includes marketable securities which may be mispriced. No, not possible. So if they are taking marketable securities, quick ratio is also taking marketable securities. No issue. So that same, I need a difference, right? Pro forma cash flow statements focuses on cash flow. Doesn't matter. We are looking for the current and the quick ratio. So that is wrong statement here given. Conversion of inventory. Conversion of inventory into cash is less reliable. Yes. Conversion of inventory is less reliable. Cash, inventory, the only difference between them is inventory. Okay. Good. So yeah, good answers. So the difference we got it. So yeah, try this question. I need a 2-minute break and then we'll continue again. Okay. We are taking a 2-minute break. Hello everyone. Let's continue. Okay. Next question. 6th number. The selected financial information of a luggage manufacturer is shown below. Based on this information provided, the luggage manufacturer's quick ratio is, okay, quick ratio includes quick assets divided by, write the formula first. Quick ratio is equals to quick asset divided by current liabilities. Let's find first quick assets. Quick assets, cash. Yes, we'll take that cash. Plus account receivable. Yes, we'll take that also. Plus inventory. Inventory le lu, nahi lu? No, no inventory, right? Inventory will not be considered in our current quick ratio. Marketable securities. Yes. So that makes 531,000 plus 439,000 plus 2 lakh. 1.170 million. Current liabilities given or not? Yes, given 6 lakh. Oh, 5 lakh. So simple as that. Just write it down. Quick assets 1.170 million divided by 5 lakh. So that makes 2.34 is your answer. Option number C. Let's see who has given the correct answers. I guess many of you has given the correct answer. Yes, Maruti correct. Vishwajit Chakravarti is correct. Maruti Prasanna correct. Jeet is correct. Arzu is correct. Naveen is correct. Good. Yeah, just try to answer. Good, good. I like this. Okay, a huge question. Bromol Corporation has decided to include certain financial ratios in its year-end annual report to shareholders. Okay, yes, that's great. That's good enough. Selected information related to its recent fiscal year is given below. Bromel's working capital at the year-end. Working capital formula I want to hear. I don't want in chat. I want to hear. Working capital is equals to? What's the working capital?
Current asset minus current liability.
Yes, good, Vishwajit. Current liability. But we need to find the current asset, no, first. Let's find it out here. So current asset, cash. Yes, cash. Include it. Account receivable, include this. Prepaid expense, go for it. Inventory, go for this. Then accounts payable, no. Notes payable, no. Bonds payable, no. Credit sellers, no. Nothing else. So 10,000, 20,000, 8,000 and 42,000. So that makes 80,000. Current liabilities includes accounts payable 15,000, correct. Notes payable in 90 days. Yes. Yes, Maruti. Yes, Maruti, want to say anything?
No. I'm just like want to add that notes payable.
Yeah.
I mean, that comes under CL, current liabilities.
Sorry?
No, I just want to say that notes payable will be the part of current liabilities. That's it.
Yeah. So that our answer is 40,000, right? That makes option A. Very simple. All of the followings are affected when merchandise is purchased on cash. Oh, sorry, on credit. When I purchase merchandise on credit, except dash, except, the one will not get affect. If I purchase inventory, current assets goes up, total current asset increase. Yes, it is affected. If I purchase, so I told you, right? Purchase, see, if I purchase, now my current assets will go up. Current asset will increase. Current liability will increase. So if it is increase, there might be possibility of decrease in the current ratio or the increase in the current ratio. So either increase or decrease. So my current ratio is affected, current asset is affected, current liabilities is affected, current ratio is also affected. But what is not affected? Working capital. 5,000 inventory purchase. 5,000 accounts payable also increase. So no net change, 0. So that makes D to be correct answer. Yes, correct. Next. Which products incorporation of the following current assets? Current liabilities 1.3 million. Now see, if it is given like this now, do one thing. Find out the current ratio and the quick ratio both. See, your options are current ratio will increase, current ratio will not change. Current ratio will decrease, quick ratio will not change. Find the current ratio. Current ratio is 2.6 million divided by 1.3 million. So that gives greater than 1. Okay. Quick ratio includes except 2.6 million less 1.45 million. 1.15 million. So I just gave you the notes here. Just now only I gave you all the notes. We don't want to calculate this again and again. 0.88. Your quick ratio is less than 1. Your current ratio is greater than 1. Current ratio will decrease if a payment of 10,000 of cash is 1 lakh of cash is used to pay to the 1 lakh of accounts payable. Decrease, increase. But they are saying decrease. So not A. Current ratio will not change. Of course it will change. So that is not also A. B also. Quick ratio will decrease if a payment of 1 lakh is cash is made to purchase inventory. Inventory increases, cash goes down. What is this? No change. 1 lakh inventory comes, 1 lakh cash goes. Quick assets, it will change, guys. It will change because in our particular quick ratio, we don't consider inventory. So only outflow of cash is there, no inflow of inventory. So your quick asset decreases, which will decrease your numerator and ultimately your ratio goes down. So option C is correct. Okay. Quick ratio will not change. Of course it will change. Of course there will be a decrease. For example, see, if let's say they made cash payment and when they make the cash payment of 1 lakh, they will reduce the cash. So quick ratio now would be 1.05 million divided by 1.3 million. See, it has decreased. It has decreased. So that C is your answer. So I told you that points, right? So be focused on those points. That's very much important. The quick ratio at the end of the year is, they're asking at the end of the year. So see, in this, the question is given just showing you a manipulation. They are manipulating you by giving January 1, December 31st. No need to consider for January. Just consider for December 31st. So for quick ratio, we need quick assets 62,000 plus marketable securities 35,000 plus account receivable 47,000. That's it. Yeah. Current liabilities are accounts payable 84,000. Accrued liabilities will consider or not? Should we consider this accrued liabilities or not? What are accrued liabilities? Should we consider this accrued liabilities or not? Accrued salaries or accrued wages. It's a short-term term. Yes, Maruti, tell me.
No, yes, we have to consider.
Okay, we'll consider. So that is 144 divided by 95,000. 1.15, no, 1.52. That makes D. Okay. So it's a easy things. Davies Retail Incorporation has current assets of this and current ratio is 2.3 times. Current ratio 2.3 greater than 1. Purchasing merchandise on credit. I purchase inventory on credit. Accounts increase, decrease. Increase, decrease. So now the new value of your current ratio would be lower than 2.3. Numerator increase, denominator increase. Overall ratio goes down if the ratio is greater than 1. See, that's the power. That's the only power of those notes. So are you all getting those notes? Why I gave you how beneficial they are. Okay. Next. Gurstaka Auto Parts must increase its asset taste ratio about the level of 0.9. Okay. Right now their level is 0.9. In order to comply with the terms of loan agreement, due to some loan agreement terms, they need to increase this. Which one of the following actions is most likely to produce the desired results? What they should do? So right now it is 0.9. That means lower than 1. If it is lower than 1, then decrease, 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 and increase, increase, increase. So either they should increase their quick assets or they should increase their current liabilities. Both. Okay. So expending collection of account receivables. If you collect your account receivable, doesn't make sense, right? You collected 5 lakh of account receivable. So 5 lakh reduced from account receivable and 5 lakh cash increase. So no change. Selling auto parts on accounts. You are selling auto parts on accounts. Selling auto parts on accounts means you are selling on a particular inventory and you don't consider your quick ratio. You don't consider your quick ratio, right? Inventory. So that means there is a sale. You are selling it. And when you sell, yes, selling on credit. Selling on credit means nothing goes. On your account receivable goes up. That means your current ratio, quick ratio goes up. Quick ratio goes up means numerator is going up and the overall ratio goes up. That means option B. So to increase my quick ratio, I need to sell my auto parts on account, not on cash. Either if it is cash also, then also your quick ratio will go up because your inventory is not reducing now. You don't consider your inventories in quick ratios. So that B. Okay. Making payment to trade, decrease, decrease, decrease. Purchasing marketable securities for cash doesn't make sense. You pay cash, your marketable securities increase. No change. A owner of a chain grocery store has bought a large supply of mangoes and paid for the fruit with cash. He purchased inventory for cash. This purchase will impact which one of the following? Is it gonna impact your working capital because there is no change in your current assets? No working capital. Current ratio, because there is no change in quick current assets. So no change in quick current ratio. Asset days ratio, yes. Why? Because your quick assets goes down. Inventory is not gonna include it in your quick ratio. So that makes C to be correct answer because it is going to be impacted. Okay, and price to earning has no relation with these ratios. So that's doesn't make sense. Option C is correct. When reviewing a credit application, the credit manager should be concerned with the application dash. Credit manager means the one who gives the loan, one who approves the loan. He must be concerned with your dash. Profit margin, no. Are you liable enough? Do you have sufficient liquidity? So that makes no price to earning ratios. Yeah, working capital is correct, but no return to equity. So they will check your working capital and your current ratio. Are you capable enough? Do you have certain amount of liquidity? Are you complying your liquid ratios or not? So that makes D to be correct. Both the current ratio and quick ratio for the Spartan Corporation has been slowly decreasing. So yeah, that is slowly decreasing for the past 2 years. The current ratio has been 2:3 and 2:1. 2:3 to 1 and 2.0 to 1. Okay, it has decreased. During the same time period, the quick ratio has decreased 1.2 to 1. The disparity between the current and the quick ratio. What's the difference between the current and the quick ratio? I know that. You know one thing, in this question, I always laugh while solving this question. The information from here to here is of zero use. Read this statement. The disparity between the current and the quick ratio. What's the difference between the current and the quick ratio is? Current ratio calculate inventory entry paid while quick ratio doesn't. So current portion no, cash balance no, account receivables no, inventory balance is unusually high. So that makes D. So wherever I look at inventory, I will just tick on that. That's very simple, right? So this is what the benefit of yours when you study with me. Okay, so that is just a joke. But yeah, I will help you like how to solve such questions. They are only asking the difference between the current and the quick ratio. So why to go for all such things? So they will try to manipulate it. Okay. The acid test ratio shows the ability of a company to pay its current liability without having to dash. Reduce its cash balance? No. Pay additional funds? Borrow additional funds? No. Collect its receivables? No. Without liquidates its inventory? That's D. Okay. All of the following are included in the calculating the acid test ratio except dash. Which of the following is not going to include it in your acid test ratio? Which is that? 6-month treasury bills? No. It is included. Prepaid insurance? No. Prepaid insurance is not gonna include it in your quick ratio because you include your current account receivables. You include your 60-day certificate of credit. That means a short-term liability. So only you don't consider is prepaid expense. So yes, okay. Dedam Corporation has decided to include certain financial ratios in its year-end and annual report to shareholders. Selected information relating to its most recent fiscal year is provided below. Cash is given 10,000. Account receivable is there. You need to find the acid test ratio. So for acid test ratio, I need quick assets. 10,000 is my cash. 32,000 is my account receivables. Prepaid expense 8,000 I will not consider. Inventory 30,000 I will not consider. So that means my 42,000 is my quick assets. Current liability includes accounts payable 15,000 plus notes payable 25,000. Let's make 40,000. So ultimately my quick ratio is 42,000 divided by 40,000 is 1.05. That makes D to be correct. Very simple and silly question. So see, as you can see, many questions are relating to your quick ratio. So that is an important one. In your exam also, you can face such questions. If a company has a quick ratio of 2.1, greater than 1, okay, and pay off a portion of its accounts payable with cash, that means your numerator decrease, denominator also decrease. Decrease. What will happen? Your current ratio what will happen? If the ratio is greater than 1, your numerator decrease or denominator decrease. Ultimately, the ratio goes up or down, increase or decrease. Yes, increase. G, it's greater than 1. If it is greater than 1, then decrease, increase, opposite. Okay. So yes, good, Naveen, correct. So the option B. See, without any huge calculations, we can easily solve such questions. Okay. So yeah, that was our day today. That was now from tomorrow we'll start our new, not tomorrow, now from Monday, we'll start our new topic that is solvency. Okay. We'll solve two topics the next class, solvency and leverage. We'll complete the next unit by the next class. Okay. Two topics are remaining to cover this. So yeah, that's my time. I hope that everyone enjoyed the class. Is it so? Everyone enjoyed? Yes, Naveen, I will just, let me just, Naveen, can you please send it again? Because I need to scroll that again and again. No, Maruti, that is Glam. The one I am using now is Glam. So yeah, tell me guys, have you all enjoyed today's class? Have everyone got it? Just give a thumbs up. By giving a thumbs up, I will got it. It is enough for me. Because I need such feedbacks from you all. It's very much important for me. I will send in the WhatsApp group, don't worry. Okay. I will send the Google Calendar link. So yeah, everyone understood now whatever I explained today. It was very simple thing that I explained. I tried my best to explain you all and be confident that yes, you will do it. Now see, what you need to do once we end this, review the one that we studied. Like what you need to do is basically you just need to revise the topic, read it once, remember things and try to make a note if possible. Then open the Becker, in that select the topic that we did and practice. Just 10 question practice, that's it. You will gain confidence. Okay? Because that is the most important thing. and ultimately you have the best faculty, I guess. Aman Asudani. Okay. So anytime if you get any issue, just remember one person. That's me. Okay. So don't worry. I am there. VGLD team is there. Be clear. Be confident. That's it. Okay. And if possible, provide a suitable feedback to me also. Okay. Because yeah, that's an important thing. And I will send you all my LinkedIn profile. Go and follow that also, because sometimes I share some inside things to those things also. So be there. Okay. Bye bye. Good night, everyone. Best of luck and clear your aim and be present on Monday, everyone. Okay. No need to like miss out any class. Just try to be present. Okay. Bye bye. Good night, everyone. Take care. Bye, everyone. Vikas Singh. Vikas ji. Hello, Vikas ji. Bye, Naveen. Hello, Vikas ji. Okay, bye bye, everyone. Good night.